Hello friends. In today's video, we'll provide you with an overview of the stock markets. This video is divided into three parts. In the first part, we'll understand the need of a stock market. In the second part, we'll understand why stock prices vary. And in the third part, we'll summarize the entire video by giving you or by laying down the importance of stock market. And this is our first video on stock market overview. In the second video, we'll be talking about some day-to-day terms which you must be reading in newspapers like Sensex, Nifty, BSE, NSE, FIIs, DIIs, mutual funds. So we'll be providing you with an understanding of all these terms. So let's start with the first topic. What's the economic logic behind stock markets? Before we understand the economic logic, let me pull out something from a previous session or a previous video. So if you remember the first video, we learned about a concept called economic system, where we talked about factors of production. Remember that? If not, just view that video again. So we talked about factors of production. What are these factors of production? These are the inputs that are used in production of goods and services. And what were these? These were land, labor, and capital. So basically, if I want to produce something, what three things do I need? They are land, labor, and capital. If I take this thing into attention, capital. So let's say someone has to set up a factory. What do they need? They need land, labor, and capital. So how can they generate this capital, or how can they source this capital? There are broadly, two ways to source this capital. Either they can take a loan to set up a factory, which would mean they take debt. And what happens once they take debt? They pay it back. So they pay back the debt along with the interest. And this component is obligatory, which means that if this person who has set up a factory and he has a raised capital via debt or loan through a bank, and if he fails to pay back this principal along with interest, the uh, so he can't fail. He has to pay it back. It's an obligation. If he fails, the party which has lent him that money, the bank which has lent him that money, they have the right to confiscate the assets and recover their money, just like what's happening in Vijay Mallya's case. So the banks have lent him money. He has failed on his obligation, and now they are selling his assets. The other way to raise capital is through investment. So I want to raise capital. I reach out to few people. I ask them to invest money in my business, and in return, I give them ownership of my business. Okay, so here it was a debt. Ownership was not transferred, but in this case, I am giving the people who are investing, who are giving me money, who are investing in my business, I am giving them ownership. So in return, what I do, I share profits with them. Profits which are generated out of this business, out of my venture, I share profits with them. Now the interest and this debt, returning that debt was obligatory. Sharing profits is non-obligatory. So idea is that you are investing in my business, and this is the risk of investment. Okay, so reward is that my profits may be normal, maybe super normal. Here, if as an interest I am earning, let's say 5%, as a profit I might earn 15%. But what I am doing in return, so I am taking more risk. It's a riskier option. Why riskier? Because there is a potential to earn more here. So once a person invests in my business, what I do, I issue these people uh, what we call as stock or equity, which is a representation of ownership. Representation of ownership. So one who invests in my business, I issue them stock or equity, which defines that which signifies that they have an ownership in my company. Now there can be two types of ownerships in a company. One can be private, one can be public. So this investor, which we are saying that he's investing money in my business, he can be either a private individual or he can be a public person. So when it comes to private, consider an example where Ratan Tata invested in Snapdeal. That was a private investment. Ratan Tata investing money in Snapdeal. That was a private investment where the transaction was between Ratan Tata and Snapdeal. So Snapdeal was this company which wanted to raise capital, and Ratan Tata was this entity which gave them money and took ownership in the business. The other thing can be, let's say, any other a company where general public is investing. Okay, public like you and me. So obviously you would think that Ratan Tata is a wealthy man and he must be investing in millions, if not billions. But person like you and me can invest in thousands, right? Maybe in few lakhs. So what's the concept of public investment is that here finding Ratan Tata is tough, right? There are very few Ratan Tatas in the world, but there are lots of people like you and me who have small earnings and who have the capacity to lend this money to a private enterprise so that it can operate, the enterprise can operate. And uh, when this public lends company a money, this is called public investment into the business. Now the question is, how do you find this public? And the answer is that this public is available on stock market. So when a company wants to raise money, it can do two things. Either it can find Ratan Tatas of the world, which are very few. Okay, it has to make one-to-one connect with Ratan Tatas of the world, or it can come to a stock market like BSC or NSE, where a lot of people like you and me are available, and the company can say that, okay, this is my business, okay, and I want to raise money for this business. So I say that, okay, I have, let's say, 10 lakhs share, which is this part. I'm selling these 10 lakh shares. So people give me money, and in return, I'll give you the ownership in my company. And this entire concept happens on a stock market. And that is what the purpose of stock market is. Stock market is nothing but a marketplace, sorry, but a marketplace where the companies or the corporates can come to raise money from the larger public. So it's tough to find Ratan Tatas, but it's easier to find people who have small investments, who are ready to make small investments. We can channelize those investments, okay, and provide that investment to the companies who can then invest that money in their business and grow that money and earn profits for these owners who have invested, the public. They can generate profits for the public. So this is the entire economic concept behind stock market. The concept is to raise capital for the companies, okay, to raise capital from the public, and in turn giving them ownership of the companies and giving them an opportunity to earn more than normal profits by having some risk, by taking some risk. This is the economic concept of stock market. Now, uh, let's understand why there is a price variation in terms of why price variation happens with stocks. So as we understand, there's a company which wants to raise a capital. Okay, the company wants to raise capital, so it goes into the stock market. Okay, and what it does, it launches an IPO, which is initial public offer. Through an initial public offer at the stock exchange, this company says that, okay, this is my business, this is the unit price of my stock, unit price of stock, and now I invite the public to apply for my stock. So once the public applies, I'll issue them my stock. I'll take their money. Okay, once they apply, the company says that I'll take their money. In return, I'll issue them stock. And this money I'll put in productive purposes. So I'll use it to grow my business and then return this money, return the profits uh, uh, as dividends to the what we say to the investors. Now, once this process is over, okay, the stock gets listed. The term is listed. It gets listed on the exchange. So we have seen earlier, exchange is nothing but a marketplace where the buyers and sellers they get in touch with each other and they trade in stock. So stock gets listed on the exchange. What's the idea behind listing on the exchange? As you know that the stocks now have owners, right? Who hold the shares of this company. What if they want to sell those shares? They want to make an exit from their investment. They will, the exchange provides them the means to sell their stock, to make an exit from their investment. At the same time, the same owners may say that, okay, I have bought few shares in the initial public offering. I now want to buy more shares of the same company. So from the same exchange, they can buy more. That's the purpose of listing the stock on exchange. Through IPO, they get the money. The company gets the money or gets the capital. Through listing, they provide liquidity of their stock so that the interested investors or interested people can buy and sell the stock. So having said that, you see that now the stock is listed on the exchange, it's getting bought and it's getting sold. So the price of the stock varies because it's listed on the exchange. And there are now two reasons why the, the stock price varies. First, let's understand what's the meaning of stock price, price of the stock. So price of the stock represents the value this company is carrying. So let's say the price of a stock was 80 and now it becomes 90. It means that the company is becoming more very valuable. From 90, if it goes to 100, the company is getting more valuable as compared to what it was 80. And let's say that from 80, if the stock price moves to 50, it means that the price of the stock, the value is decreasing. There can be two reasons why this value is decreasing. The first reason is fundamental reason. So let me ask you a question. When will you say that the fundamentally a business is good or the business is improving? When you see that the scope of the business is improving. And how do you define this scope? How do you define the fundamentals of the company? When the company's profits, margins, or revenue is increasing. So how you say that a company is growing? Either the company's revenues are growing or its profits are growing or its margins are improving. That's what the fundamentally drives the stock price up. That is the fundamental reason of driving of stock price up. So those people who invest with this scenario in mind, that the company, I'm investing in this company with the hope or with the conviction that the company's revenues, margins, or profits will improve, that is called investment. So people invest in that business. It is always long-term thing. So these things, profits, margin, revenues, they don't improve in short term within a month or two. They take years to improve. And people who make investment with these parameters in mind, they wait for their investment. They wait for years so that their investment can grow. So if I see that these parameters of a company are improving, my stock price will start going up. Or if they are going down, if these parameters are not improving, my price can start going down, which means that the value of my stock can go up or can go down, driven by the fundamentals. The second reason why the price of a stock may vary is because of volatility. Volatility, or in other words, demand and supply. So you know that in one of our previous videos we discussed this concept of demand and supply. If demand increases and the supply is same, the price will go start increasing. Okay, so in case of a stock, let's take an example. Rakesh Jhunjhunwala, for example. Rakesh Jhunjhunwala is one of the investors in stock market, and he buys stock. Let's say he buys a stock X. So when he buys this stock X, he's making an investment. He sees that this stock has the potential to rise. But let's say Rakesh Jhunjhunwala is only one person, but there are millions of people in India who follow Rakesh Jhunjhunwala. They don't understand that the why he has bought this stock X. But since Rakesh Jhunjhunwala has bought the stock, these millions of people, if not millions, at least thousands of people also start buying this stock X. So what happens? There is no change in the company fundamentals. Rakesh Jhunjhunwala has bought this stock with a hope that these fundamentals will improve. But these people have bought just because Rakesh Jhunjhunwala has bought. Okay, so when they start buying, they start demanding more, and the supply is same. So the prices of the stock will move up. So the price here happens because of trading. So it's a trading variation. Trading means that I buy with an expectation that the price will vary. So for example, I buy at less price, and once the stock price moves up, let's say within a day, within a month, or within 2 months, 3 months, within a week, I immediately sell it. So I'm not looking at the fundamentals, I'm just looking at opportunities so that price variation happens. This price variation can be news based, can be event based, or can be through these factors like the one I talked about. So traders come into picture here, and they I would say they take advantage of this price variation. In fact, there's a concept called day trading. So what happens is that you buy in the morning and you sell in the evening, and with the conviction that by the time you sell, the price would have moved up. Okay, and you would make some profit. So that is called day trading. That also happens. However, you need to understand that the company, the initial corporate which has raised money through IPO, is not receiving any money through these things, through fundamentals or through volatility or trading. The company receives money only when it comes out with an IPO or a follow-up offer. Through trading, through fundamental trading, or through volatility or sentiment based trading, this company is receiving no money. Okay, so this was about stock price variation. Now let's understand the importance of stock market. In fact, we have seen the importance. The first importance is for the corporates to raise money. So they can go to bank or they can go to stock markets to raise money. Second part is, or the second what we say, the importance is, it helps in channelizing the wealth or the money into productive assets. So just like the concept of banks, where small retail saving people like you and me, we deposit our money in small chunks, okay, in thousands and lakhs, and collectively this money is lent by a bank to an enterprise so that they can invest it in a business and give bank an interest, and bank pays us back this interest, a part of this interest. In the same manner, stock market is carries the stock market has the same objective, that as there are multiple small investors whose money is channelized into enterprises with a profit sharing arrangement in place. Okay, so there is no obligation, by the way, but yes, it helps the investors earn wealth, earn profits which are more than the interest which they are earning through the bank route. So that's the second one. And the third and most important one is that uh, stock market is an indicator of an economy's strength. Stock market is the primary indicator and indicates whether this economy is going in a positive direction or in negative direction. Let's understand this point. This is very important because you will see in lot of cases that fluctuation in stock markets actually tell or actually indicate that the economy is going on the right path or not. Let's understand how. So if the economy is growing, recall from our video of economic growth, what happens if the economy is growing? Your GDP will go up. Why? Because economic growth is nothing but an increase in production of goods and services. So when GDP increases, it means that there is an increase in production of goods and services. And who are producing these goods and services? These are the companies which are producing, the corporates. Okay. Where are these corporates? Most of the corporates or the industry leaders, they are there on the stock exchange. If we talk about India, let's take few segments. If I talk about IT, Infosys, TCS, they are all listed company. If I talk about pharma, Sun Pharma, Cipla, they are all listed. If I talk about automobiles, Maruti, Bajaj, Hero, they all are listed. So what happens when companies and corporates produce more? We are saying that there's an increase in production of goods and services and corporates are producing more. Producing more means revenue is going up, means profits will grow up or margins may improve. And what will happen once these things happen? The stock prices of the listed companies, they will go up. Stock prices of listed company, they will go up. So how is stock market an indicator of economic strength? If a economy is growing strong, we saw that ultimately the stock prices will go up because of fundamental reasons. Fundamental reasons of these three, the stock prices will move up. So if an economy is growing, its stock market will go up. If the economy is not growing or economy is on a decline, the stock market will decline. Again, the reason is same. A declining economy means uh, going a GDP that is going down, which means goods and services, the production is decreasing, which means the company's revenue will go down, and eventually stock price, which is nothing but the value which a company carries, it will go down. And once the stock price goes down, the overall market, which is constituent of multiple companies, at an overall level, it will go down. So some companies still may show improvement, but at an overall level, this will go down. So uh, you will see that this generally happens when we call this as a crash. This is called boom. So when the economy is going up, it's called boom, and stock market crash is nothing but the stock market as a whole going down. In fact, you will see that most of the economic bubbles, like the bubble of, like the Great Depression, the bubble of 2000, which we called the IT bubble, or the subprime crisis 2008. The first indicator that this bubble has burst was the crash of stock market. So when things happen, when bad things happen in economy, it's the stock market that takes the first hit, and that's why it's called an indicator of economic growth or economic prosperity or economic poor performance as well. So we'll be discussing about these economic bubbles, uh, the concept of bubble, the concept of crash, and these economic bubbles in detail in some other video. But for the next video on stock markets, we'll be talking about few terms like NSE, BSE, what they are. They are nothing but exchanges. Then like terms like Sensex, Nifty, Dow Jones, you might have heard of it. Then concept of FIIs, DIIs, mutual funds. So we'll be talking all about all these concepts in the next video. Thank you for listening. I hope you understood a new concept today. Uh, Looking forward to you to join us in the next video. Thanks once again and good luck with your preparation.